Yeah. So in continuation of the 15 points to take into account when you want to make an investment. So I stopped at number 10. So now we're going to continue. And so number 11, are there other aspects of the business somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? I think that is self-explanatory. Are there other aspects of the business somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? Okay, so I'm gonna give an example. Let's say insurance costs, property insurance, property, the assets and all that, even life. So we're gonna take safety for example. A company that's invested in a safety procedure, like is a company, is a normal organization. They got maybe they got a factory, they got a lab and all that. But safety precautions is being taken at every step of the way. There's smoke detectors, there's sprinklers, there's a proper construction of the stairs, with the appropriate labeling, safety signs at the required places. The safety protocols is on point. So this is gonna reduce insurance costs. Like I said, are there other aspects of the business somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? Some companies might be like, okay, we're not into, construction or stuff like that. So why should we spend so much money on safety? But not spending money on safety might lead to increase in accidents. So having increased accidents, you're gonna spend money on hospital bills, compensations, and all that. And insurance, you're gonna increase your insurance costs because insurance, they're gonna take all this into consideration. So, but when you spend money on safety, even though it's just an office, but you make sure all the safety protocols are in place, then there's less insurance costs, less probability of accident. And also another example is patents. When you have the patent for a product, or for your service, or for your idea, you have a competitive advantage over others. That's another example. So that means if you're trying to invest in a company, you don't just go blindly and invest. You have to talk to personnel in the company and talk to competitors. Talk to competitors of their company, and and in their industry and all that, just to get your facts before you make your investment. Because remember, this is your money. You ain't trying to lose your money because you worked hard for this money. So that's number 11. Number 12, does the company have a long range or a short range outlook in regards to profits? You understand? If you look at the activities of the company, from what you've seen, from their policy, their mode of operation, is it based on long term or short term? Remember, does the company have a long range or short range outlook in regards to profits? So from the way they do the things, is it based on long term? Do they have a long term goal or a short term goal? And how can you tell this? Their customer service. The way they treat their customers is going to tell you, because a company that wants to be there for decades is going to take, it's going to be thoughtful. It's going to be considerate. It's going to be, it's going to be intentional when it comes to customer service, because it wants to keep its customer for the long haul. A company that overpays vendors, not like overpay, but because there might be times where you don't have, where the shortage of cash flow and you need supplies. Your vendors is gonna give you the supply because they know that, okay, when you had a lot of cash flow, you overpaid. So you have a little bit of deposit with them and all that. So these are things that you have to look at, because these things, they matter. Companies that do this, they have long-term inclination. Companies that do the opposite, maybe, they don't have that kind of inclination. So you might not want to invest in those companies. So that's number 12. Number 13, does the company in the foreseeable future, will it grow? Does the growth of the company in the foreseeable future require sufficient equity financing so that a larger number of shares than outstanding will largely cancel the existing stockholders' benefits from its anticipated growth? So let me just, in case you don't understand that, is the company's cash flow and borrowing ability sufficient for the capital required for future growth? What is borrowing ability? The ability to get loans. You understand? The cash flow. You know what cash flow is? The money, the liquid money that you can use for everyday activities, day-to-day activities. So the cash flow that this company has, or his borrowing ability, is it sufficient enough for the capital that might be required because of for future growth? Because now you've checked the company, you've seen the potential for growth, you've seen that this is a company that can diversify, that has diversification in its plans. So now, you're saying, okay, so after looking at this, now you're thinking, okay, you check the cash flow, you check their data, their financial data. Does the cash flow or the borrowing ability of the company, will it be sufficient enough for that anticipated growth that's going to happen in the nearest future? You take that into consideration. So that's number 13. Then number 14, does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointment occurs? That's self-explanatory. So when things are going well, the companies are good. They are so eager to let investors know, this is going, everything is going good. This is the analysis. This is the breakdown. But when things are not going well, because it's not going to go well all the time. There are bad years, but companies are built to survive. That's why we say you play the long game, because the bad years is gonna come, but there's another year that's gonna follow that. Do they open up to investors when things are good, but when things are bad, they're trying to hide. They're trying to duck. They are not relating the situation to the investors. So companies that do that, they might not really have good intentions. It's a human nature. But as a company that you have people investing their money, there's an open policy. Investors have to know, when things are good, when things are bad. So companies that are open throughout the ups and downs, those are the companies that you want to invest in. So the last point, does the company have a management of unquestionable integrity? Does the company have a management of unquestionable integrity? I think that's self-explanatory as well. Does the management of the company have unquestionable integrity? We can relate this to politicians. Like politicians in Nigeria, for example. These are the top management of the company. Because Nigeria is the company, the politicians, the presidents, the senators, the governors, the ministers, these are the top management. So now, are these politicians, are they of unquestionable integrity? As an investor, are you going to invest in Nigeria based on the integrity of the top management? I think the answer is no. So it's the same thing. You relate that with the company. Because some companies, they put relatives in positions and pay them salaries. They pay them on deserving salaries that are way higher than the work that is being put in. You understand? Or a salary is way higher than the industry average, than the work. You know, some they lease their own properties to the company at higher rates than the market rate. You know, these are questionable characters. So you have to take this into consideration. So this is 15 points. You know, 10 points in the previous video, then 5 points in this video. So now, all you got to do is watch this video 3 times at least. Because you might not get it the first time. Because now you don't want to, you know, because now you don't have the time to read. If you can read, then go ahead, you know, there's books. To study on these topics, on this information. You know, I can recommend a book. There's a book called Common Stocks and Uncommon Profits. Common Stocks and Uncommon Profits. You check that out. You don't want to read. There's the audio on YouTube. You understand? There are people that you can listen to. You know, people like George Gammon. You know, you can check out the channel on YouTube. You know, these are guys that you know, financial dudes. You know, people like Ken McElroy, but I think Ken is more like real estate. But you know, so you can check out some audios. You know, if because you ain't got time to read, but at least you can plug in your earphones and listen to some audios on financial intelligence. But you know, like I said, you might have to watch this video 3 times at least. Watch it over and over. Then you can, you know, then on those points you can build on them. Make your research, put your money. Because me myself, you know, I've made blind investments. Because my friend told me, oh, yo, this is, you know, this. I didn't make my research, and I lost my money. And it's not good. It doesn't feel good to lose your money. So you have to do the needful to make the right investment. Remember, you have to make your money work for you. Because you can't keep working and working and working. So yo, that's it, man. I'm gonna come back because I'm gonna come back with don'ts. I'm gonna give some points on don'ts for investors, things that you shouldn't do. This video is about things that you should do, things that you should put into consideration when you want to make investments. So I'm gonna come back with another video of things that you shouldn't do. So thank y'all for rocking. Like the video, subscribe to the channel, and I'm gonna see y'all later. Peace out.